Welcome to you both. And Karen, put this number into the picture that you had previously and that you're monitoring at LinkedIn about where the labor market sits. Because we do see other signs of decelerating demand for workers. How does this change the picture, if at all?
Yeah, absolutely. So this was definitely a hot number, as you say, in terms of headline. But I think if you look under the hood, you are seeing some fraying around the margins. So, for example, labor force participation rate is been inching down over the last 3 months. You're seeing temporary employment also kind of cooling off. These are signs, harbingers of weakness to come. So from our perspective, the labor market is still tight. It is still resilient. We still see pockets of momentum across various sectors. But there are signs that the labor market is going to continue to cool, by degrees every month by month. It's probably, though, not enough for the Fed to kind of want to feel comfortable.
For sure. And Jack, I mean, the Fed has done a pretty good job of making sure that investors don't get too comfortable either with what they're about to do. They're trying to stay vigilant, even though Jay Powell, Fed chair this week, had a more balanced take on exactly how they can proceed from here. So how does the job number today impact your thoughts on what the Fed's going to ultimately do and what it can mean for the markets?
Yeah, frankly, Mike, I mean, I don't think that today's employment report does a whole lot in terms of Fed thinking. Because as we heard earlier, there are some signs of fraying, right? One of the metrics that we like to look at on our team is not just what's going on with the establishment survey, which is what you're typically going to be quoting when it comes to those 260,000 plus jobs that we saw added for the month. We also like looking at the household survey, and that is telling a very, very different picture. We actually shed jobs to the tune of almost 140,000 household jobs for the month, right? Very different story from what we're hearing in the establishment survey. The labor market is not as strong, is not as healthy as a lot of us fear. And I say fear because we kind of live in this perverse investing environment where good news is bad news. And as you said, Mike, right, the numbers that we saw out today are good news for workers. They're not so good news necessarily for markets because it does mean that the Fed is still going to move forward. We see 50 basis points in December. We see at least another 25 basis points coming in February, perhaps a 25 basis point hike after that. All of that means nothing has really changed in terms of our outlook. I think that one data point from today is not going to influence the Fed one way or the other.
Although, Jack, does that also by extension mean that the bond market essentially already had this priced? And that seems to be what the stock market is working off of to figure out if, in fact, we can see the end of the tightening campaign for now, at least a pause. And then what does it mean for the economy and earnings next year? I guess I'm trying to figure out the elusive soft landing or not question.
Yeah, well, Powell still seems to think that soft, or at least soft-ish, is attainable. I'm a little bit more skeptical about that. I do see this economy likely heading into a recession in the short term, with or without the pressure of higher interest rates. We have a massive fiscal drag. We have inflation that is stuck around and is eroding at consumer confidence. I do see the economy continuing to slow. What I don't see, though, Mike, is a significant recession because there are no obvious areas of imbalance. There are no bubbles. There's nothing booming from a macroeconomic perspective. And that's helpful perspective to have, I think, because not all recessions are what we saw in 2020. Not all recessions are what we saw in 2008. Whatever is coming our way, I think, is going to be mild and mellow. The second takeaway from that, then, is that if we do get a mild, mellow recession, I would not expect the Fed to pivot anytime soon, especially taking rates down to zero. That is, I think, not happening anytime in the near or even medium term. So we do have to get used to this environment of higher rates. It is very much here to stay.